Once the world's most trusted mobile phone brand, Nokia dominated every continent. Its phones were indestructible. Its name was synonymous with connection. But in just a few years, the giant stumbled. Software, smartphones, and shifting markets changed everything. How did Nokia go from unstoppable to almost forgotten? This is the rise and fall of a legend. Nokia began in 1865 as a small Finnish company founded by Fredrik Idestam. Initially, it operated as a pulp mill, producing paper in southern Finland, taking advantage of the abundant forests and rivers for transportation and energy. At the time, the company's scope was extremely limited, serving local markets and focusing on industrial production rather than consumer products. Idestam's vision was to combine innovation with industrial efficiency, a mindset that would later influence Nokia's approach to technological development.
By the late 19th century, Nokia diversified into rubber and cable manufacturing, gradually building a foundation for future expansion. Rubber boots, tires, and insulating cables became part of its portfolio. These early diversifications were crucial because they allowed the company to survive economic fluctuations and acquire expertise in industrial processes. The strategy of diversification created a culture of adaptability, which would become essential during the technological shifts of the 20th century.
Entering the 20th century, Nokia expanded further by merging its operations with Finnish Cableworks and other regional companies. This consolidation gave it the scale needed to compete on national and eventually international levels. It also created the financial and managerial capacity to invest in new industries, particularly electronics, which was just emerging as a global force. Nokia's leadership understood that future growth depended on anticipating trends, not merely reacting to them. The 1960s and 1970s marked the beginning of Nokia's electronic ambitions. It began producing radios, televisions, and early telecommunications equipment. Recognizing the growing importance of communications technology, Nokia invested in research and development, positioning itself at the frontier of a field that would soon explode in global demand. Early collaborations with Finnish universities and European partners allowed the company to gain knowledge in emerging digital technologies and cellular networks. By the early 1980s, Nokia had formally entered the telecommunications sector, manufacturing mobile phones and infrastructure equipment. At the same time, the company sold off its non-core businesses, including parts of the rubber and cable divisions. This strategic decision focused Nokia on its telecommunications vision, enabling it to channel resources into research, manufacturing, and network expansion. The risk was significant, but it demonstrated leadership willing to sacrifice short-term security for long-term growth. Nokia's early mobile phones were notable for simplicity, reliability, and long battery life. These features, seemingly minor at the time, established a design philosophy centered on user experience and durability. Consumers quickly recognized Nokia devices as dependable, a reputation that would become one of the company's greatest assets. The company also invested in global logistics and supply chain efficiency. By streamlining production and distribution, Nokia ensured that it could deliver devices at competitive prices to markets across Europe and eventually Asia and North America. Operational excellence became a cornerstone of the company's early competitive advantage. By the mid-1990s, Nokia had established itself as a significant player in the telecommunications industry. Its focus on innovation, reliability, and operational efficiency positioned it to capitalize on the upcoming mobile revolution. This era marked the beginning of a trajectory that would take Nokia from a regional industrial player to a global technological leader. By the late 1990s, Nokia had grown into the world's leading mobile phone manufacturer. Its devices were used by millions across continents, making the brand instantly recognizable. The company's success was built on a combination of technological innovation, strategic vision, and deep understanding of consumer needs. Nokia's phones were durable, reliable, and designed for simplicity, qualities that appealed to both developed and emerging markets. The company's marketing strategy played a critical role in establishing its global presence. Slogans such as "Connecting People" resonated deeply, reflecting the company's mission to bridge communication gaps. Nokia's campaigns were not only about selling devices, but about promoting a lifestyle of accessibility, convenience, and reliability. This emotional connection with consumers strengthened brand loyalty, creating a psychological attachment that competitors struggle to replicate.
During this period, Nokia dominated the mobile phone market, capturing significant shares in Europe, Asia, and parts of North America. Its devices ranged from entry-level phones for first-time users to more advanced feature phones equipped with messaging, games, and rudimentary internet access. This wide product range allowed Nokia to serve diverse demographic and economic segments simultaneously, giving it a scale advantage over competitors. One of the most iconic devices of this era was the Nokia 3310. Renowned for its durability and battery longevity, it became a cultural phenomenon. The phone's reliability reinforced Nokia's reputation for quality and practicality, while its simple interface made it accessible to users of all ages. Such products created not only customer satisfaction, but also global brand recognition, solidifying Nokia's market dominance.
Technologically, Nokia invested heavily in research and development. It contributed to GSM standards, cellular network expansion, and early mobile internet technologies. By collaborating with telecom providers and industry partners, Nokia influenced the direction of mobile communications on a global scale. Its commitment to technical excellence ensured that devices were not only functional, but compatible with emerging networks worldwide, strengthening Nokia's competitive advantage. Operationally, the company mastered supply chain management and mass production. Its ability to produce large volumes of devices without compromising quality allowed it to scale globally. This operational efficiency also made phones more affordable, expanding accessibility and widening the consumer base. It created a virtuous cycle. Increased sales fueled further investment in innovation, reinforcing Nokia's leadership. Financially, the golden era was extraordinarily profitable. Revenues soared, and Nokia became one of the world's most valuable companies. Its stock performance attracted investors, and the brand's image reflected both commercial and technological leadership. Nokia's success was seen as a model of corporate strategy, combining vision, execution, and consumer insight effectively. However, even at the height of its dominance, early warning signs of emerging challenges appeared. Competitors began experimenting with smartphones and alternative operating systems. Consumer expectations were gradually shifting toward integrated digital experiences, combining hardware, software, and connectivity.
Despite these subtle changes, Nokia's leadership largely relied on its existing strategies, emphasizing incremental improvements to feature phones. This focus, while profitable in the short term, planted the seeds of future vulnerability. The company's enormous success created a sense of security that made rapid adaptation more difficult. By the early 2000s, Nokia had reached peak global influence. It was not just a company, but a symbol of mobile communication worldwide. Yet beneath the surface, changes in technology, consumer preferences, and competitive dynamics were quietly reshaping the industry, setting the stage for the challenges that would eventually follow.
The mid-2000s marked a pivotal moment in Nokia's history as the mobile phone industry began a dramatic transformation. While Nokia remained the dominant provider of feature phones, the market was shifting towards smartphones, devices that offered not just communication, but computing, entertainment, and internet connectivity. Consumers began to expect more than basic functionality, and the industry was entering an era defined by software and integrated ecosystems. Nokia had anticipated the rise of advanced mobile devices and developed the Symbian operating system to power its early smartphones. Symbian offered features like email, messaging, web browsing, and basic applications. Initially,
This platform positioned Nokia as a serious contender in the emerging smartphone segment. However, the system's architecture was complex and difficult for developers to work with, limiting the number of applications and slowing innovation compared to competitors.
At the same time, competitors were redefining the mobile experience. Companies such as Apple and BlackBerry introduced intuitive touch interfaces, robust app ecosystems, and integrated services. Consumers began to value devices that could function as complete digital tools, capable of handling productivity, entertainment, and social connectivity seamlessly. This shift highlighted the growing importance of software, ecosystems, and user experience. Nokia's internal structure, once a strength, became a challenge. The company's large size and multiple divisions led to slow decision-making and conflicting priorities. Innovation cycles lengthened, and the company's response to market changes lagged behind more agile competitors. The bureaucratic layers that had supported global scale now hindered rapid adaptation, creating strategic inertia.
While Nokia continued to focus on hardware durability and reliability, the market was moving towards experiences rather than devices alone. Consumers increasingly considered software performance, application availability, and ecosystem integration when choosing smartphones. Nokia's inability to fully embrace this new paradigm left it vulnerable as competitors captured mindshare and market share. Efforts to modernize Symbian and introduce new smartphones were met with limited success. Developers struggled with the platform's complexity, leading to fewer applications than on rival ecosystems. This feedback loop weakened Nokia's competitive position. Fewer apps led to lower consumer demand, which further discouraged developer investment.
Internally, debates over strategy intensified. Some executives advocated incremental improvements to existing products, while others called for bold shifts to embrace emerging smartphone standards. The lack of consensus slowed implementation and created uncertainty, leaving Nokia's response fragmented and inconsistent. By the late 2000s, the industry's transformation accelerated. Touchscreen interfaces, app stores, and integrated services became standard, redefining consumer expectations. While Nokia still produced reliable hardware, the company struggled to match the sophistication and seamless experience offered by competitors.
This period exposed the vulnerability of Nokia's market position. Its legacy of dominance could not compensate for the failure to adapt quickly to software-driven ecosystems. The company's reliance on past success slowed its innovation trajectory, creating openings for new entrants to seize leadership. The turning point was clear. Nokia's golden era of feature phones was ending. The company faced an urgent need to restructure, innovate, and align its strategy with the emerging digital landscape. Failure to act decisively would have long-lasting consequences, as the market's rapid evolution was unforgiving to delayed adaptation. As smartphones gained momentum, Nokia's dominance in the mobile market began to erode. While still the global leader in feature phones, its products increasingly appeared outdated compared to competitors offering integrated experiences. Reliance on the Symbian operating system became a critical weakness. Symbian's complex architecture and limited developer support created a growing gap between Nokia and the emerging smartphone leaders. Efforts to modernize Symbian were slow and largely ineffective. Developers found it challenging to create applications, resulting in a sparse ecosystem compared to Apple's iOS or Google's Android. Consumers began to prioritize app availability, smooth user interfaces, and integrated digital services, areas in which Nokia lagged. As a result, the appeal of Nokia devices diminished, even among loyal customers who had trusted the brand for years.
Internal challenges compounded these external pressures. Nokia's large organizational structure, once a competitive advantage, became a liability. Decision-making was slow, and divisions often acted independently, creating inefficiencies.
The company's traditional emphasis on hardware durability and physical reliability was insufficient in an era where software and ecosystem mattered more. In response to the changing market, Nokia explored partnerships and platform alternatives. The company recognized that maintaining Symbian alone could not secure its position. Leadership debated whether to build a new operating system internally or collaborate with external software companies. These deliberations, however, were lengthy and delayed the introduction of competitive products. Meanwhile, competitors captured both high-end and emerging market segments. Apple introduced sleek, touchscreen devices with an intuitive interface and app ecosystem, while Android offered a flexible platform that appealed to multiple manufacturers. Nokia struggled to offer a comparable experience, losing its previous market advantage. The company's brand, once synonymous with innovation and reliability, began to lose relevance. Consumers increasingly associated Nokia with legacy technology rather than cutting-edge design. Market share in Europe, Asia, and North America declined, reflecting the growing preference for smartphones capable of handling diverse digital tasks. Financially, Nokia faced mounting pressure. Declining sales and shrinking margins created challenges in maintaining profitability. The company initiated cost-cutting measures, including workforce reductions and operational restructuring, in an effort to stabilize performance. However, these measures could not reverse the underlying strategic misalignment with market demands. The shift away from Symbian created uncertainty among developers and consumers. This transition period weakened confidence in Nokia's products and delayed the adoption of new devices. Competitors capitalized on this gap, further eroding Nokia's market presence. By the early 2010s, it was evident that Nokia's era of mobile dominance had ended. The company faced the stark reality of rapid technological change, shifting consumer expectations, and aggressive competition. Its position as the world's leading mobile phone manufacturer was no longer tenable. This phase represents the beginning of Nokia's collapse. Years of incremental improvements and reliance on past success could not counteract the rapid innovation and ecosystem development pursued by rivals. The company now faced an existential challenge, where decisive action would determine whether it could survive and reinvent itself or continue a steady decline. The early 2010s, Nokia's decline accelerated as the company struggled to regain its footing in the rapidly evolving smartphone market. The transition away from Symbian and toward a new operating system faced major challenges. Consumers had grown accustomed to the convenience and app-rich environments offered by competitors, leaving Nokia behind in both perception and functionality. The company formed a partnership with Microsoft to adopt the Windows Phone operating system, a move aimed at reviving its smartphone strategy. While this decision demonstrated Nokia's willingness to embrace change, it also came with significant risks. The Windows Phone platform had limited applications compared to iOS and Android, and consumer adoption was slow. Developers were hesitant to invest time and resources in a relatively unproven ecosystem, further limiting device appeal. Nokia's reputation, once built on reliability and durability, was no longer sufficient to retain market share. Consumers increasingly prioritized devices that offered seamless integration with applications, social media, and internet services. The market had shifted from hardware-centric value to software-driven ecosystems, a paradigm in which Nokia struggled to compete. Financial pressures mounted as sales declined. Revenues fell sharply, and the company faced margin compression due to competitive pricing and reduced demand. Cost-cutting measures, including layoffs, operational restructuring, and the closure of certain facilities, were implemented to stabilize finances. While these actions reduced expenses, they also impacted employee morale and the company's ability to innovate rapidly.
Nokia's brand loyalty eroded as new entrants dominated consumer attention. Companies like Apple, Samsung, and emerging Android manufacturers captured both premium and entry-level markets.
Nokia, previously the leader in both segments, now trailed behind competitors who had embraced modern smartphone design, intuitive interfaces, and robust ecosystems. The decline culminated in the eventual sale of Nokia's mobile phone division to Microsoft in 2014. This marked the end of an era for the company, symbolizing its exit from a market it had once defined. The decision to sell was both a recognition of the company's diminished position and a strategic move to focus on its strengths in telecommunications infrastructure. Nokia's brand loyalty eroded as new entrants dominated consumer attention. Companies like Apple, Samsung, and emerging Android manufacturers captured both premium and entry-level markets. Nokia, previously the leader in both segments, now trailed behind competitors who had embraced modern smartphone design, intuitive interfaces, and robust ecosystems. The decline culminated in the eventual sale of Nokia's mobile phone division to Microsoft in 2014. This marked the end of an era for the company, symbolizing its exit from a market it had once defined. The decision to sell was both a recognition of the company's diminished position and a strategic move to focus on its strengths in telecommunications infrastructure.
Even after divesting its mobile division, Nokia continued operations in network equipment and communications technology. The company leveraged its expertise in networking, infrastructure, and research to re-establish relevance in a different segment of the technology industry. This shift demonstrated resilience and an ability to pivot, but it also highlighted how quickly market leadership could be lost in a dynamic industry. The fall of Nokia illustrates the consequences of failing to anticipate industry transformation. Over-reliance on past success, slow adaptation to software-driven ecosystems, and internal organizational challenges contributed to the company's rapid decline. While hardware quality remained high, it was no longer sufficient to secure leadership in a market dominated by integrated experiences.
Nokia's experience serves as a cautionary tale for other technology companies. The story underscores the importance of agility, ecosystem development, and strategic foresight. Companies must recognize that market dominance is not permanent and that continuous innovation is essential to maintaining leadership. Ultimately, this phase of Nokia's journey emphasizes how external disruption, combined with internal inefficiencies, can transform an industry leader into a company struggling for survival. The sale of its mobile division marked the final stage of its collapse in the consumer market, leaving lessons that resonate across industries today.
The rise and fall of Nokia provides endearing lessons for businesses, innovators, and technology leaders. One of the most critical insights is the necessity of anticipating and adapting to technological change. Success in rapidly evolving industries requires constant vigilance, strategic flexibility, and the willingness to make bold, sometimes risky, decisions before competitors do. Nokia's decline illustrates the danger of relying too heavily on past success while underestimating market disruption. Another key lesson is the growing importance of software, applications, and ecosystems in modern technology markets. Consumers no longer base purchasing decisions solely on hardware quality. Instead, integrated experiences, app availability, and seamless connectivity are decisive factors. Nokia's hardware remained high quality, yet without a competitive software ecosystem, the company could not maintain market leadership. This underscores the need for companies to consider the full ecosystem surrounding their products, rather than focusing exclusively on physical devices.
Organizational agility is another factor critical to sustained success. Nokia's large size and complex structure, which had been advantageous in its rise, eventually hindered rapid decision-making and innovation. Bureaucratic layers slowed responses to competitive threats, illustrating how even highly successful organizations must find ways to preserve flexibility as they grow. The ability to move quickly, align priorities across divisions, and implement strategic changes decisively can determine survival in fast-moving industries. Strategic clarity and foresight are essential components of long-term competitiveness.
Nokia's leadership at times debated whether to focus on incremental improvement or pursue radical change, resulting in delayed responses to market shifts. Companies must establish clear strategic goals and ensure that organizational alignment supports timely execution. Confusion or hesitation in leadership can magnify the impact of industry disruption as competitors seize opportunities more effectively.
Timing is also critical. Recognizing shifts in consumer preferences and technological trends early allows companies to act decisively, securing a competitive advantage. Nokia's experience demonstrates that delays, even of a few years, can have dramatic consequences when the market evolves rapidly. In the technology sector, the pace of change is relentless, and failure to respond quickly can result in rapid erosion of market share and brand relevance. Despite its decline in mobile phones, Nokia's legacy remains significant. The company played a foundational role in establishing global mobile communications, helping to connect billions of people worldwide. Its contributions to network standards, hardware durability, and early mobile technology set benchmarks that influenced the entire industry. Today, Nokia continues to operate in network infrastructure and technology services, demonstrating resilience and the capacity for reinvention.
Nokia's story serves as both inspiration and warning. It exemplifies how strategic vision, innovation, and operational excellence can produce global leadership, yet also illustrates how quickly that leadership can be lost without continuous adaptation. For contemporary businesses, the lessons are clear. Remain customer-focused, embrace technological change, invest in ecosystems, and maintain organizational agility. Ultimately, the rise and fall of Nokia reflects the dynamic nature of the technology industry. No company, regardless of size or market dominance, is immune to disruption. Long-term success depends on the ability to evolve continuously, respond to new challenges, and innovate relentlessly. Nokia's journey remains a touchstone for understanding both the heights of corporate achievement and the consequences of strategic complacency in a fast-changing world. Nokia's journey shows that even the greatest companies can fall when innovation slows and markets shift. But it also shows resilience. A company can reinvent itself, focusing on strengths and new opportunities. From connecting billions to building the networks of tomorrow, Nokia's legacy continues to shape technology worldwide. The rise and fall of a giant is not the end, it's a lesson for all of us.